Welcome, everybody. Bill West, West Advisory. I am a business broker with Acquisition Experts and a business consultant with West Advisory. Let's get to where we can share. And with me today, I have Ryan Coughlin, and he has my name down there. He used my login as well, but Ryan Coughlin is with us. Ryan is the Senior Market Sales Executive for Florida for Capital One Bank. Myself, so I actually our background, Ryan and I, as John kind of mentioned, I've been in banking, around businesses, around small businesses, just have a passion for helping businesses. Have been working with them more than 30, almost working on 40 years, I guess, that I've been working with entrepreneurs. After I left the Marines, I pretty quickly found my way into banking, and from banking, I pretty quickly found a passion for small business and for entrepreneurship. Ryan and I met along the way, I guess halfway kind of through that course. So about 20 years ago, Ryan and I met, and we were on a commercial lending team together. Got to know each other really well. Had absolutely no doubt that he would be the successful banker that he is today, and really excited to do this with Ryan here. So my background, like I said, so it's been 30, 40 years of working with businesses. I've seen cycles of businesses. I've seen I've seen economic cycles, and I've seen cycles of businesses, right? So you've seen people talk about the recessions and things that we go through, and there's obviously the peak times as well. There are also cycles that businesses go through. They go through there's a startup phase, figuring it out. How do I do this? What am I going to do? Going through that phase. You start to mature, you start figuring things out, and I like doing this better, and this works better, so I'm going to go this direction, and then you really get it rolling, and over time you become successful, and there hits a time down the road where it's time to retire, it's time to do something else. Hopefully you've thought about it early. We'll kind of I'll get into my presentation probably. I am picking up here. For some reason, there we go. But so you get into wanting to transition, needing to transition out of your business and onto either the next generation or to sell it to somebody else, right? So that you can live your happy retirement that you worked very hard for. So what we're going to do today is kind of go through how you would go about selling your business. Selling your business, it's something you can do yourself. It's possible to do yourself. There's great value in what I do as a business broker, as we'll kind of see when we walk through this. It's difficult to do it yourself, but it's absolutely possible, and we're going to kind of roll that out for you. We're going to start off with some higher level kind of items. It is segmenting the business, right? So there's within businesses, there are very small Main Street type businesses. This has it segmented into small Main Street, lower middle market. There are variations of businesses within that. I particularly have a passion for businesses that sell to other businesses. They're not necessarily the retail names that you would know, but I love working with they're some of the most unique and businesses that you never would have guessed could be a business, and it's a lot of fun. I think Ryan kind of shares that passion with me, but there are Main Street, there are retail focused businesses, consumer focused businesses, and there are business focused businesses. Main Street, this divides the Main Street, less than $500,000 is one category. 500 to $1 million is a little bit larger category, and these will make sense as I go on to the next slides of how they kind of fit in. What a $1 to $2 million business for a Main Street business is a pretty significant business there. Lower middle market, 2 million to 5 million, 5 million to 50 million. These are I am in Florida. I think most of our attendees are in Florida here, and these are pretty typical of how the Florida market would segment. So back to Main Street. So this is kind of segmenting, and as I was talking about the businesses that sell to consumers versus the businesses and the businesses that sell to other businesses, right? So in the Main Street, you have a heavy concentration of businesses that sell to consumers. If you look at the largest percentage of them down there, restaurants is the highest, personal services, that's going to be your hair cutting, your massages, those kind of things. Business services is typically a business to business kind of thing, so that makes its first appearance. Three in consumer goods and retail, it's anything you buy at a grocery store, any kind of store. Construction and engineering kind of covers both of them. So as we move along in the main street, so as businesses become bigger, there's fewer and fewer of them that sell to other businesses, and more of them that sell to there are fewer and fewer of them that sell to consumers, and more that sell to other businesses. And then in the lower middle market, you see kind of the same thing. It's a heavy concentration of those. You see the opposite. You see the heavy concentration of businesses that sell to other businesses, and then less of those are the larger companies. That less of the larger companies are companies that sell to consumers, directly to consumers. This one is a little fuzzy, but this is something that I really wanted to highlight. So this is reasons why deals don't close. So if you're selling your business, I mean, we talk about business cycles and everything, begin with the end in mind, right? So you're selling your business, begin with the end in mind. What might go wrong along your path of getting to that, and knowing what those are going to be. The top reason why deals don't close is the seller isn't realistic on the valuation. They don't know what the business is worth. They're asking too much for it. Frequently is the case. I see them where they don't ask enough. I've definitely seen them where they don't ask enough, but the seller is asking too much is frequently the top reason. Economic uncertainty always exists. There are times where it's higher. Now might be one of those times. It is one of those times. But economic uncertainty certainly plays a part in there, especially as I'm going to let Ryan kind of chime in here early about economic uncertainty, rising interest rates. That might be a good place to pick up and introduce Ryan here.
Sure. Well, thank you for that, Bill. And again, I'm Ryan Coughlin. I'm the market executive for the state of Florida for Capital One Bank. And so we work with businesses of all types. I would consider my bankers to be generalists, truly. I mean, because we deal with, super high-end net worth real estate developers to the mom and pop. That's, as Bill alluded to, kind of that lower middle market space, $2 million gross revenue and above. But there is a lot of uncertainty in the marketplace. And a lot of our economists are predicting that we're probably going to see another rate hike here on November the 1st. And so what does that do? That puts a strain on the financial system, obviously a strain on the consumer, the end user, the business owner, because it costs them more to do business. And so it's going to be interesting to see how things kind of pan out over the next few years in obtaining financing and being able to get the financing that you need, because a lot of banks are going to be a lot tighter with their lending criteria, because liquidity is going to be at a premium. And so making sure that you kind of set yourselves apart as business owners, and making sure that you're caring about the quality of your financials internally, whether you're selling your business or whether you're going to look at buying a business. It's really, really important, because obviously the bank is going to want to qualify you, and with banks standards, all banks across the board, standards are going to be getting a little tighter. You want to make sure that you're qualifying yourself ahead of time. And I know business owners we talk to, sometimes they say, oh, well, I don't want to pay a bunch of taxes. So I am showing that I'm losing money on my tax returns, but I'm really making money. You can see it in my bank statements. Well, that's all fine and good to the IRS, I guess, because you're saving yourselves and having to pay a big year-end tax bill. However, when you're looking to obtain financing, you really have to show that you're profitable. And that you can debt service, or you can service the debt that you are looking to obtain from a financial institution. And so what are some things that you want to do? Obviously, like I said, you want to show that you've got profitability. You want to show that your business has retained earnings in the business on the balance sheet as well. So it looks like you're managing your books very, very well. So what are some things that you, as a business owner, whether you're looking to buy or sell, some things that you need to really make sure are looking really tight from a financial perspective? Well, number one, you want to have a personal financial statement. And this is stating your personal wealth, assets, and liabilities, and making sure that that's dialed in. You know the ins and outs of that. You want to make sure that your business tax returns at least show the very most recent year, let's just say 2022, has profitability. It's difficult to go into a bank and show, hey, at 2022 fiscal year end, I was negative, but 21 I was positive. Well, that trend is negative. So a positive trend is really important. So having, you're going to want to come to the bank with at least 3 years of business tax returns and also what's called an interim financial statement, profit and loss of balance sheet. So for 2023, for instance, you'd want to come to the bank with a year to date through let's just say September of your profit and loss, showing your revenue versus your expenses, and then your balance sheet showing your assets versus your liabilities year to date. And that shows the bank a trend. So they can see a positive or negative trend, and they can also do their cash flow analysis to say, well, this business cash flows or does not cash flow. Also, you being the business owner, your personal tax, essentially you are the business, right? Like some business owners, they come in and say, well, we want to do, I don't want to sign the dotted line. I don't want any personal guarantees, right? It's not called non-recourse lending. It's very difficult for non-publicly traded companies to get non-recourse lending. We've seen some businesses $500 million and they still have recourse on there because essentially you are the business. So making sure that you're showing your personal tax returns that you've got a healthy cash flow, so to speak, on the personal tax returns versus your personal liabilities, because the bank's going to do what's called a global debt service coverage ratio, which takes into account your business, your personal, everything all in one globally, and that's going to give them the global cash flow. So again, personal financial statement, 3 years business tax returns showing a positive trend, 3 years of personal tax returns showing nice cash flow from your personal revenue versus your personal expenses. And then you're going to want to show the interim financial statement, as I alluded to. That's going to show your profit and loss and balance sheet from January through whatever the last month was, this in this instance being September. And then the bank will also ask you for a debt schedule. What a debt schedule is if your business has any outstanding debts out there, let's just say they've got $1 million line of credit outstanding. Well, you'd show that on the debt schedule, what the outstanding balance is, what the monthly payments are. Maybe there's a loan to shareholder. You would put that on your debt schedule as well. And then also you would want to have your accounts receivable aging and your accounts payable aging. This just shows your receivable aging. Obviously, for those of you who don't know, some of you probably already know this. Receivables are the monies coming in for the services rendered, and there's the time it takes you to achieve those accounts receivables. Maybe it's 30, 60, 90 days. And then your payables, right? So you've got bills that have to be paid. Maybe you've got payment terms and you only have to make payments on certain terms every 90 days. So that payable will be 90 days out. So your accounts receivable aging and your accounts payable aging are things that the bank is also going to require. And then one last piece, Bill, and I'll turn it back over to you. For those of you, obviously, look, Bill is your go-to. And as you're looking to either buy businesses, if you're exiting a business, you want to buy another business, something that a lot of clients are really looking at today, especially with the tightening of the belts of the financial institutions, is going SBA. Look, Capital One, we're fully SBA, fully SBA preferred bank, so we approve it in house. It's approved with the SBA. But something to look at, because there's several banks out there that do this. SBA lending is great if you're looking to finance leasehold improvements of the business, do equipment finance, do debt finance. We do 90% financing for business acquisitions and 100% financing for partner buyouts. If you're maybe a law firm, you're buying out a partner, 100% partner buyouts. These are great ways to obtain that capital that you need at a very low cost, especially in 2024, the SBA has waived their guarantee fees, which is tremendous. So you can get a loan up to $5 million with the SBA 7A program, no guarantee, no SBA guarantee fee, which is tremendous right now. So these are things I want you all to consider, especially when working with Bill, because these are ways for you to really maximize how you're obtaining financing and also minimizing the amount of equity injection you're having to put in when buying or selling a business. So I want to throw that 2 cents out there. But any questions on that before I turn it over to Bill?
I think we're going to do the Q&A at the end, so I'll
You got
keep
it. Sorry,
on.
Bill. You got it.
Perfect. No, I want to pick up on exactly. So a lot of what Ryan is talking about is it's qualifying the business, right? So qualifying your business. I mean, if you look through these, I just want to sew it back into these reasons why deals don't close, and they fit perfectly. He literally, I don't think he was looking at the list, but he was going down the list as he was talking. Poor financials, keeping your financials in order, it definitely makes the business sellable. The financing that Ryan touched on, most of the businesses that I sell do use SBA financing. It is a tremendous tool. When I'm doing the valuations and everything up front, I'm looking at these businesses. Is this qualifying for SBA financing? Because it creates a whole new market for you. When you're trying to sell your business, you want to be you want to have a competitive market, right? You want to be able to sell into, have options, right? And SBA financing, having those buyers, it's going to be 20% of the options out there. Another good method of doing it, if you own a business free and clear, or you've been in business for a long time, is seller financing. There's tax advantages and other reasons why you want to do it. You'd want to do it very, very carefully and very, very cautiously, because you're being the bank, and that's why my background tends to lean pretty nicely into that, into qualifying buyers, which is something we're going to pick up on fairly shortly here. But just to keep on going down, so financing is an issue. Unrealistic buyer value expectation, unrealistic buyer expectations, I think would fit in there. Period. Ryan kind of alluded to some of those with the personal guarantee comments. Deal fatigue. Time kills deals is a well-known mantra. If you get into a deal and there's hiccups with it, you don't have your financials in order, and you need to go back and do that, and then the buyer starts asking a question, time kills deals, deal fatigue. People get really tired of just going along and working with both sellers and buyers. Lack of seller preparation, I think, goes into everything that we were kind of speaking of before. So we will move on to the next slide. Again, okay, so by deal size, right? So under $500,000, as you expect, less resources, less ability to create good financials. They're not going to have a CFO certainly on staff. If they have a bookkeeper, sometimes these under $500,000 businesses, financing, when you get into that $500,000 to $2 million, you are very much talking about financing being an issue. SBA financing, exactly to Ryan's point. And then you get up into unrealistic seller expectations. I guess in that mid-market, sellers think that they're worth more. There's different, when you're valuing a business, there's different ways, or when you're purchasing a business, there's different ways to value them. And sellers in this $2 to $5 million range sometimes think that they're in a different category than they are. In that bigger range, it's unrealistic buyer expectations. I think they're just you're making deals there. It is a very high level when you get into those $5 to $50 million. Very, very smart people and business people that are very active there. Reasons for selling by market, reasons for selling. All right, so retirement is by every category. Is the top reason. Burnout, you definitely get burnout sellers. I have actually enjoyed lately, I've been seeing some retirees that are not burnout. They're just happy and excited about to go off on life and celebrate their retirement. And that's pretty neat. It's not neat when you're burnout on a business, as Ryan and I have both seen, especially when you get into economic circumstances that are difficult. Family issues happens a lot. I see businesses. This is a sad thing, really. It's things happen to business owners, and a lot of familial wealth disappears when businesses aren't sold or aren't ready to be sold if something happens. I think that would actually be a bigger category if businesses were better prepared to sell under those circumstances. New opportunity. There's definitely people that hey, I'm a serial entrepreneur, right? I've done this twice and I'm about to do it 3 more times. So there are certainly those that are out there. Exit planning. I kind of alluded to this earlier. Retirement's it. Retirement, you're going to, if there's death and taxes, they say these certain things. If you're in business, at some point that business is going to be sold. You should be planning for that. You should be planning for that at the beginning. It's that begin with the end in mind, Stephen Covey. When you go out into a business, okay, what are my alternatives? You're not necessarily building it to sell. You know, I know that's one kind of theory. There's books and things out there, but you're building and have options, right? You want to have options with your business. If something happens, I want to be able to sell. That is an option that you're creating for yourself. I want to be able to pass it down to my kids if everything falls in line. So thinking through that exit planning at a very early stage. I'm sure Ryan can speak to this as well. Ryan, what have you seen where it worked really well, right? There's good examples out there, great examples.
Yeah, so I think something to think through again, when you're thinking about exit planning, a lot of buyers, it depends on the industry, but they're going to want to buy at a certain multiple of your book value. So think about your EBITDA, your earnings before interest, taxes, depreciation, amortization, and a multiple of whatever that number is what the buyer is going to want to buy your business for. So you want your books to be as profitable as possible because essentially whatever that profitability is versus via that EBITDA, that multiple of book value, so that multiple of EBITDA is essentially what you're going to be offered from someone buying your business. So you really want to look really clean. You really when you're like, hey, this is the year we're gonna go up for sale. We want to exit the business. Make sure that things are tight. Make sure that you know all the books. Don't put it on someone else, right? Like the business, like I said, it's you. So take ownership of that. Know the ins and outs. Don't just say, oh, well, my bookkeeper, my accountant, my CFO, whatever. Like because you'll start being asked questions, right? You're going to be asked questions by the future owner, the buyer, of what's the day to day, what's it look like, and if you don't look like you don't know the ins and outs, it's only going to hurt your valuation with that buyer. So know your business, know your numbers, and make sure your numbers look extremely clean when you're going to sell. It's the most important time.
Let's see. Exit planning. We're going to get into selling your business here really quickly and get it moving. Exit planning prior to sale. This is again kind of saying the same thing. How many people did exit planning prior to sale? A lot of them didn't do anything. You can see that kind of changes as businesses go up, as businesses tend to be larger, they tend to do more planning. All right. Valuing your business. So I am going to switch what I am showing you here. Okay. Valuing your business. As Ryan kind of alluded to, the business valuation, it's very much it's a function of your owner's benefit or your EBITDA, depending on the type and size of a business. Owner's benefit tends to be in the the $3 million and under kind of range. EBITDA tends to be a multiple that you would use. So there's financial buyers and there's strategic buyers, and that's kind of what I was saying about how so it's one thing, it changes how you're multiple, but there's factors in the math that so it's not an apples to apples kind of comparison. But most trying to move these screens around to where I can get to mine. All right, so when you're valuing your business, it's very much a function of that EBITDA or that owner's benefit that you calculate. It's also a function of what else is sold out in the market, right? So there are comparables that you're using, that you're comparing to. People, when you think of houses and you go to sell your houses or you get a house appraised, they get comparables. So it's similar to that. It's difficult to get to a region. You can't do it on a neighborhood kind of level like you do residential real estate. You're trying to get as close as possible. With a business, you're trying to get to compare it to a business that's as close as possible with you, and that can be difficult to get. To do that, like I said, I like to look at it as I'm running through, and I'm just going to quickly show this so that we can kind of get on to the things. But I like to make sure a business is financeable with SBA financing. So this is a commercial construction manufacturer, just kind of run through. Again, I'm in banking, we would call this spreading the financial statements. In business brokerage, they call it recasting the financial statements. But I'm going to look at the financials, compare them side by side, have this ready for a banker. Ryan is going to love this when he gets handed in this kind of format. These are adjustments that I'm making, and you have to be sensitive to Ryan, I'm going to let you speak to adjustments, but I make the adjustments that are very, very clear, very, very plain, that a banker is going to buy into. If you go into a banker with a list of it's 20 items and they're $100 and $200 a month or something like that, it's not going to make any sense. He's not going to. You're really trying to push it. When you're doing your business, you want it to be as clear and as clean as possible. You don't want to be running things through your business. You want those books to be pristine so that you have less questions in a transaction. Ryan, I've hidden you from myself, but if you're why don't you speak up here? And
Yeah, no, I love this, Bill. And so Bill, as he's showing, this is really important, right? Because now he's backed out, like I was talking about the EBITDA piece, but he's also backed out compensation to officers because again, that's on you. You can take whatever you can take $0 if you want. You can take the full compensation that the prior owner was taking, and he backed out like the things that are the golf memberships, the things that are not going to be ongoing forever because that gives you your true bottom line EBITDA, true bottom line book valuation, essentially. So this is great what he's doing here. And again, like I said, know your numbers because you'll be asked these questions and you want to know, you don't want to just put it on somebody else, pass the buck, so to speak. You want to know your business, know your numbers.
and that goes back to that uncertainty we kind of talked about. If you have everything right and it's up front, it's right, and you can drill into it, you know your numbers, and you can answer questions on them. A buyer's going to have a lot more confidence in you. You're going to get a better price for your business because of that. I'm just kind of running through. This is more just the balance sheet, same thing. These common size numbers are very important, as Ryan and I would use these a lot in banking. You can compare yourself to other companies. You can compare trends over time. That's a totally different webinar, but good stuff to have. A little 5-year forecast, very simple forecast that I complete. SBA, it's something that you're going to look at for SBA financing and stuff. And then you get down into the multiple. So what I use for my database to solve my, how do I get as close as possible? It's an SBA database. It's closed SBA loans. So I've got that data by industry, by NAICS code, by business size that I can segregate and I can statistically analyze to come up with what is the proper multiple, right? So this one happens to 3 is a pretty common multiple. This one was 299. That's the right type of multiple using this seller's discretionary income for this type of business. To use EBITDA, you're leaving in part of the owner's benefit. You do that recasting a little bit differently. So you're leaving in the salary where you're taking it out for seller's discretionary income, and you're recalculating it. It's got to be a buyer that really fits into what they're doing already to be able to realize those kinds of multiples. So I'm going to flip back to our slideshow. I don't think I needed to stop sharing to do that. Just needed to go here. Okay. So this is seller's sentiment. So this is talking about how our sellers is feeling about the market over time. The market was tremendous through COVID. You saw the collapse during COVID, but even after that, it was really good. It has been declining. This is December of last year. Ryan, I'm sure, would tell you that trend has kind of continued. Multiples by deal size. This is what I was getting to. So in the larger deals, you do tend to have higher multiples for the larger deals. You can see the same kind of trend over time. A couple of things impact that. One is how people feel about the economy, how people feel things are looking going forward. The other thing is, is financing available for it? And I think leading that this time, though, is not just is it available, but it's been the dramatic interest rate increases that has given some people pause. Serious business owners are still absolutely buying businesses. They are good businesses. It goes up, it comes down. You're in for it for the long haul, and people are absolutely still buying businesses. But there was a time in 2020 and 2021 where there were buyers in the market that many of them shouldn't have been in the market. Using a blind listing. Okay, so you understand the value of your business. You're going to use some kind of blind listing. There are listing services that you can do, that you can find out there, And this is where it splits between using a business broker and trying to sell your business on your own. You can sell a business on your own. People do it all the time. People are up to that task. Find one of these listing services, get yourself a burner phone, and then we're going to walk into quickly how to qualify buyers and stuff. And that's the process. That's where I feel I really add value is filtering out you have a business to run. To take on this task, and it is a big task, is difficult. So, but you can absolutely, there are I've seen businesses of all types be sold by the owner. You're going to once you have listed your business, or before you've listed your business, really, you're going to want to be prepared with marketing materials. So you're going to want to prepare. I have an example here for you. I believe that. So this is just a confidential offering memorandum. It's got photographs of the business, talks about the business. I give details of the business, just description of the business, what products, services, how do they work, what are their growth opportunities, a quick summary of the business. So I've just kind of redacted this so that we could share it here. But like I said, these are the kind of businesses I like. They sell to other businesses. You would never ever guess that this could be a business and be in business, and it is a very successful business that has a really nice buyer coming in to, we've got a new generation coming in and buying these businesses, and that is a lot of fun for me. Back to, so so you're going to want to create some marketing materials to have once you have your listing. This is a confidentiality agreement, so you're going to want to, when you're vetting these buyers, you're going to want to be very selective with what you give out, and you're going to want to get a lot of information from them, right? So we're about to talk about qualifying buyers. Ryan's going to go into that. You want to make sure that your buyer has the intent to buy your business, that they're not just wasting your time, that they have the ability to buy your business, and that you're going to move down a good path with them if you can come to terms on value. So you're going to want to give them as little, and you're going to want to control what you do give them. So up front, before you even give them your business name, right? You don't want them to know who you are or where your business is. You don't want them soliciting your employees. What if they're a competitor? So you want to have a non-disclosure agreement. You're going to want to understand who they are and have a non-disclosure agreement with them right up front. This is absolutely critical for your protection. Ryan, this is 100% you. So back to the personal financial statement that you were alluding to.
Yeah, absolutely. So look, guys, when we're qualifying a buyer to buy your business, for instance, right? So let's say they come in and say, hey, look, we're going to purchase their business, they're exiting. We would collect the same financials that I was alluding to before on your business, except we wouldn't collect your personal tax returns or personal financial statement on you. However, we would still want to collect what Bill has shown today, which is the 3 years, an interim financial statement, and then the current debt schedule for the current business being purchased. Now, for the buyer, the potential buyer, for them, we'd want to get the 3 years of personal tax returns, the personal financial statement, and then we'd also want to know if they have any other businesses out there. Maybe we collect Schedule E's, if they have any related entities outside of the business that's being purchased that they're already running, simultaneously with the business that's going to be purchased. So again, we would run the global cash flow on them as well. Now, what we'd want to do, and again, for when you're doing a buy-in, a purchase like this, we would want to qualify the buyer usually with an SBA 7A program, which enables them to just do a 10% equity injection. Again, unless they're doing a partner buyout, they're already in the business. We can do 100% financing if they're doing a partner buyout. But if they're looking to purchase a business, purchase your business so you can exit, again, we could do 90% financing through an SBA acquisition program. We can go up to $5 million through that program. There's no guarantee fees. You can have a fixed rate for a full 25 years if it's owner-occupied commercial real estate. So essentially, like on the one that Bill showed, if there's real estate that comes along with that, we can go a full 25 years on that loan through the acquisition. No SBA guarantee fees. And then another piece too, and this is kind of Capital One promo. Capital One, we're doing an owner occupied real estate closing promo where we'll give $7,500 back if there's real estate involved in the transaction. So not only are you only having to put down 10% going the SBA acquisition, you're also getting back $7,500 if there's commercial real estate that you would actually the business would operate out of that's included within the loan program. Again, the SBA option, folks, it really allows for a lesser down payment, a lower monthly payment because you can go out 25 years on the loan term. The financing fees, the SBA guarantee fees are gone through 2024, which is tremendous. But it allows a borrower to retain their liquidity and continue to support your expansion, right? So you only have to put that 10% equity injection in for the purchase. So now you can really retain your capital to do other things you want to do within the business. Maybe you want to rehab the building or add new furniture, fixtures, equipment, which by the way can also be included in the SBA 7A program. So I want to throw that out there. You can actually include those improvements in the initial purchase loan program with the SBA 7A. I mean, these are ways that you can find a buyer, you can get them quickly qualified, and usually the process. Okay, so a lot of people are like, oh my gosh, SBA, it probably takes so long. It's not the case anymore. If you're working with a bank that's an SBA preferred bank, as we are, the process is fairly seamless nowadays. We have an SBA manager that works with my team in the state of Florida, that works here at Capital One, and they would hold your hand through the process, collecting the documentation, working with the buyer as well, getting everything, obviously working directly with the buyer because we're providing the financing for them, but we would hold the hand through the process. Literally, if we had the full package, as I alluded to, financial wise, our process is 10 business days to get a full approval. That's our service level agreement with our customers. We'll have you a full approval. Now, essentially, after that, there's things that are SBA required, right? So if you have a former PPP loan that's out there, we'd have to get documentation on that. That loan would have to subordinate for the new SBA loan to go into place. Maybe there's tax transcripts that have to be ordered. That could take anywhere from 1 week to 6 weeks, depending on if the if the IRS has everything that from the buyer already on file. If the buyer maybe did a tax return extension, things of that nature, those are things that could hold up this SBA closing process. But I would say nuts to bolts, like from beginning to end, give 60 to 90 days is a good window, just in case there's moving pieces that need to be fixed and that the bank and the buyer and the seller, we all need to collaborate on to ensure a safe landing to completion to loan closing so that we can finalize the acquisition of the business or the purchase of the business. It's imperative that we work on this process early on. And again, give yourself 60 to 90 days window from beginning to end so that we can ensure a safe landing for everything to go smoothly.
Perfect. Thank you, Ryan. We're going to circle back to that again in a second, but that's exactly right. Okay, so you've got you have the buyer, you have them pre-qualified. It's make an offer, right? So there's two ways that are really that you make offers now. One of them is with an LOI. It's best if you can get them right to an asset purchase agreement very quickly, but you're going to want to have, like I said, at least an LOI. Usually LOIs they're non-binding. They can go either direction. You're going to want to, if you do accept an LOI, make sure within that LOI is something getting you to this contract point very quickly, so that you know that you are dealing with a serious buyer, that you know exactly what the terms are and they're willing to be bound, right? So moving it forward, that is closing the sale, right? So you go on, you've got your buyer, you've got them pre-qualified, you're moving through they're moving through the financing. They've got the final due diligence, working on inventory, working on working capital, what's been going in and out. If there's real estate, there's title work to be done. And then there's going to be a settlement. All of the debts are going to be paid off. If you're doing an asset sale, that's most of the businesses that I do are asset sales. More and more of them are becoming stock sales now, but so an asset sale, you're going to pay off the debt, and you're going to get the balance. With a stock sale, sometimes the debt is assumed, sometimes it's paid off. There's negotiating that's done there. But the bottom line is you're going to walk away with your check. You're going to be there. You're going to see this business. Like I said, the businesses that I showed you a little bit ago, that unique business, and frequently the businesses that I see coming in, these are young, they're families, young working families in their 30s, in their 40s. They have advanced degrees. They're buying businesses from people that, frequently it was a high school degree, and a lot of knuckle busting is how you figured out how to get into your business. And then the next generation can come in, take that business that's been there, add a little bit of modern technology, put some things up in the cloud, do some things with marketing. And I've watched businesses really blossom and take on a new life. And you get to watch that as you're going off and enjoying grandkids or whatever that's you want to do with your life. You're going to have a life rather than being tied down by the business. So that is really it in a nutshell, except for time to close that Ryan kind of alluded to. Timing to sell your business. So it's again, by deal size. The smaller businesses tend to be the easier to sell, the quicker to sell. They're the less likely to have financing, right? As you go up, they tend to be more in need of financing, and they just become more complex. You start to take on those considerations that I was talking about. With a small business, it's almost certainly going to be an asset sale where you pay off the debt and you go on. With other businesses, you're negotiating over who gets inventory, who gets working capital, how much working capital is needed to operate the business. Months from engagement to close. So you can see, typically a year you'd want to plan on to sell your business at least 6 months. If you're a smaller business, like I said, if there's no financing involved, then you could sell it shorter. 6 months would be a pretty dynamic market, active selling. I guess you can kind of see those trends. I guess they came down, but it's a dynamic market if you're selling it in 6 months. Months from LOI to close, so months from the time that you're beginning, you've got a serious buyer and you're working them through that process. You can see this matches up really nicely with Ryan's 90-day window figure. And that is it until we do Q&A, and we did that right on time. Contact information, Ryan is available. Both of our cell phone numbers are there. Our email addresses are there. Ready to assist anyone who has any need, whether it's succession planning. Just if you just want, I think Ryan and I would both be available for if you just have a quick question or something that you want to ask us.
And that should be 786. I know it shows 768, but it's 786 area code. Yeah.
Thank you, Bill and Ryan. If there are a few questions that have come up, can you hear me? Can you guys hear me?
Perfectly.
Okay. From Gwen, we had a question that is, what are the sales history of consulting service businesses that focus on small business marketing and lead generation?
I'm assuming that's can you sell a business that is, so it's cash flow. It's if you do the reporting, if you monitor your business, run it through properly, if you can demonstrate that you have cash flow. One of the great things about an SBA, getting SBA financing, SBA lending for businesses, is they don't necessarily require, it doesn't have to be a real estate deal. You don't have to have hard collateral. They will allow a certain amount, or maybe even 100% of it, to be to be unsecured. Generally, it's going to be secured by the business assets, but it's not going to be secured by a piece of equipment necessarily. So if you've done all the right things with your business, if it's an active operating business, has consistent cash flow, it's growing, you've got a buyer on the other end that has experience and has that their personal credit history is right, absolutely it's sellable.
And I have a couple an add-on to that too, Bill, if you don't mind. So because with consulting firms in general, like the after-tax net profit averages between 9 and 14% of sales. So when you're looking to the buyer is going to want to make sure that you're falling in that range. So again, after-tax net profit averages about 9 to 14% of sales. And key factors are, what are the billable hours, hourly rates, number of clients, because that's essentially what they'd be buying, right? Like your book of business. And then, you want to make sure that you have contracts that are kind of a mix between industry types, geographic regions, and then making sure that your cash flow has a nice project mix. So there's not like any one individual, client that makes up more than maybe 42 to 45% of sales when it comes to consulting firms. So just things to think about as you're managing your balance sheet and your P&L before selling so that you look the most sellable to the buyer.
Okay, thank you. The next question is from Maxine, and that is, does the title company do the closings for a business?
Title
Typically, it's
company attorney.
yeah, attorney. It's a series of attorneys. You try to keep it as simple as possible, so it's as few attorneys as possible. But again, when you get into bigger transactions, there tend to be more and more. If there's real estate involved, there's title insurance. Again, it's typically an attorney's involved in the transaction, so usually it's the attorney's title company that is working on it. There are definitely there's 1031 exchanges. There are reasons for that. Some of the bigger title companies and things to get involved with transactions, but it's a business asset closing doesn't necessarily have real estate, and because of that, it doesn't necessarily have title. So title companies aren't typically closing business loans.
Okay, the next question is, what's the best evaluation method for businesses less than 500,000? Can you recommend a resource to learn how to do it?
To learn how to do it, you would study your industry. One thing, a great resource when trying to price a business, when understanding a business, just all around great resources, but especially for these kind of purposes, are industry trade associations. If you're in I considered purchasing a business at one time that had a lot of shipping containers, and there was a storage container industry association that I was able to go to and research that business and really understand, and talk to, and someone who'd been around for 40 years, and he built the business, and he had bought other businesses and knew exactly this is the math that I would do, that I would use to pay for that business, right? That is invaluable information. So I would definitely encourage you to go back to your trade associations, especially if you have something niche like that, if it's a robust association, they'll have a lot of benefit for you.
Okay. And the final question so far is, do you have experience in selling an architectural practice?
I have not personally sold an architectural practice, probably so when Ryan alluded to it, architecture, they're built around an individual frequently. It's an artist. It's an artist. You're an architect is an artist, and they're creative people. The more that you can do, so any business like that, any kind of whether it's a PR company or whatever, the more that you can do to build that business to where it's less of you and more of the business, and it can operate without you, the more likely you're going to be able to sell it, right? So if you're an architecture firm, do not name the firm after yourself, right? Name it, give it some kind of generic, some kind of modern name or something that's catchy, that's going to be a marketing type name that will be transferable, that's not stuck, that doesn't just say you. Take vacations and make sure you have staff to be able to run the operations. That if you have, if you're an architect, right, make sure that you have other architects that are doing the actual work. You are the supervisor, you are running the business, building the business, and then it's easy to, if I'm considering purchasing that business, I don't have to be an architect now necessarily. I may have to for licensing purposes, but I do not, to understand this business and to operate a business, if I have a team of 10 architects working for me and it's not me doing the architecture, I do not have to be an architect. So
And I can add on that too, if I may. So
Sure.
think about this. So 81% of a normal architect's book is non-residential services. So commercial is a majority of their book. So something to keep in mind. 8 to 13% of after-tax net profit averages about 18 to 13% of sales. And so you really want to make sure that you are you're diverse in your book, and that you've got commercial as a big portion of that. And that payroll is usually takes up about 25% of the profit and loss for an architectural firm, because essentially, it's your people that are working for you that are helping you knock these things out. Keep in mind when buying or selling a firm, so that you again look the best.
Yes. We have two more questions that came in. We have about 9 minutes before the top of the hour. Do you have experience in selling a family business 200 plus years old? That's been around
I'd
a
love
while.
to. That would be fantastic. That's
Yeah.
definitely sold some generational businesses, assisted with selling them, transferring them. Yes, if there's not a transfer, I've assisted with transfers within the family, and as well as sales that are generational type businesses. Actually, the one that I demonstrated here, it was the two what became the couple at their parents basically had started other entities that morphed into the company that we're selling today. So both of them have legacy. There's even a brother-in-law that's kind of in the mix with legacy attachments to the business, and you have to measure those. You have to be sensitive to those, and work along with all kinds of different stakeholders in a business.
Okay. And then the last question, I think, so far is, have you ever sold an electric motor repair shop or equivalent?
Selling a generator repair company currently. So
Okay.
yes, 100%.
Okay. I think that's it for questions. Let me just take one quick look. It looks like there's something might have come in. No, that's it. I want to thank you, Bill and Ryan, for this very insightful presentation. I sold a business a couple of years ago, and this brought back a lot of memories, most of them good. So you guys are spot on in terms of having your business squeaky clean and having good numbers. It's so important when a buyer comes in. The last thing I want to mention is that this is being recorded. It will be available on the Treasure Coast Score website. If you want to see a replay and spend some time on some of those slides. Some of you were commenting on the great slides, but they were tough. They were moving quickly. So you can review this later. And again, thank you all for attending. And if you have any business mentorship needs, feel free. And I encourage you to reach out to the Score Treasure Coast chapter. We're ready, willing, and able, and offering a ton of experience to help you with your small business questions. We're gonna be signing off. So thank you, everybody.
Thank you, guys.
Thank you, John. Great to see you, Ryan.
Bye. Bye-bye.
Thanks, everyone.